Welcome to Structured Finance in Focus, a Fitch Ratings podcast that takes an in-depth look at the latest developments across global ABS, CMBS, CLOs, and more. I'm Markus Papenroth, Head of European ABS, and today's episode I'll be discussing the latest trends in consumer and auto finance with Tom Deacon, a director in our team. Looking at the latest published index data, the numbers for delinquencies and defaults are largely stable. The deterioration we had been expecting for the last year and a half has shown up modestly, and if anything, performance has been better than increasing interest rates and at times sharply rising cost of living led us to believe. So, Tom, perhaps we drill down a little and start with unsecured loans and credit cards.
Thanks, Markus. So, as you say, performance has been holding up really well. There's been a slight deterioration in our unsecured indices, but from a very low base, really, and it's mostly due to changes in index composition. So there's been an increase in the share of rated non-prime deals within the index, and this explains some of the trend. We do think it's likely that there'll be some further deterioration, with increased interest rates still to be passed on in some countries. Although most loans in ABS pools are fixed rate, the indirect impact of rates resetting on residential mortgages hasn't been fully felt in parts of Europe. But overall, we're coming around to a more positive view, I'd say, with a more neutral outlook on the European consumer sectors.
And on the auto side, is it the same?
Yeah, certainly on the borrower performance side, it's perhaps slightly different in terms of used car prices, which we can come back to later. But the macroeconomic outlook is broadly supportive of asset performance, even if not much economic growth is expected. So unemployment rates are low and expected to remain there, and inflation has come down. There's only been a modest deterioration in delinquency and default rates in the auto ABS deals that we rate, and a more significant worsening is now unlikely, really, with real incomes growing again and rate cuts expected later in 2024. You'll see this reflected in consumer confidence indicators, which show significant improvements across all major markets compared to 2022 and 2023. It's true that sentiment is still worse than pre-pandemic norms, but this is consistent with the contained deterioration in asset performance that we're seeing.
So I guess the obvious question is why? If we stay with unsecured and credit cards again first and recall our expectations last year that the non-prime sector would lead to deterioration, which as we said just hasn't happened materially. I mean, there are probably two themes we saw emerging, just putting it out. So improvements in underwriting with open banking and improved models, machine learning, essentially increasing the predictive power of scoring, and also some less willingness to lend in the subprime space, I guess. And then a shift for those subprime customers to buy now, pay later, and so essentially helping these weaker borrowers away from ABS pools.
Yeah, I think especially buy now, pay later, it's quite interesting. While it is obviously a useful tool to spread the cost with zero interest, it is largely unregulated, and a couple of recent studies from the BIS and the UK FCA have been quite negative on the borrower profile. So the BIS report, it argues that buy now, pay later users tend to be younger, less educated, have higher debt burdens and lower credit scores. And the FCA also produced research that suggests that frequent users of buy now, pay later are more than twice as likely to have high-cost credit products and more than 4 times as likely to have missed a payment on bills or credit commitments in 3 of the last 6 months.
I think it will be quite interesting once this sector goes for public ratings. But back now to autos and car prices. What's the latest we've been seeing, Tom?
Well, used car prices are still decreasing in all major European economies. The UK has been most affected, with RVs as a percentage of the initial list price after 36 months down by about 14 percentage points compared to their peak back in April 2023. The pace of decline in UK RVs has been slowing down in most recent months, but it's still on a downward trajectory. Other countries are following a similar but albeit less pronounced trend, so the peak-to-trough declines as of May 2024 were about 8 percentage points in Germany and then 5 percentage points or lower across Switzerland, Spain, Italy and France. The decline in used car prices affects not only RV performance for RV handbacks, but also recoveries on defaults. So corrections in used car prices have already caused a reduction in recovery rates. Recoveries in recent periods have remained below the average of recent years. We expect these recovery rates to remain depressed in the short term, as the majority of defaults that we expect to come in will derive from loans originated during the peak of used car prices, so are more exposed to those corrections. So although we do expect defaults to remain low, the benefit of high recoveries that we've seen over the last year or two is now gone, really.
Thanks. But I guess overall, with our view that lower defaults are the main driver, the outlook is probably still better than forecast at the end of last year. Still, you mentioned car prices remain a risk, especially with additional declines we see in the battery electric vehicle sector. I mean, across portfolio, I think we see an increase in the percentage of BEVs in rated deals. In the first quarter of 2024, this was, I think, around 10%, up from 6% in 2023. I mean, initially, BEVs were purchased by wealthy early adopters, and then generous government incentive schemes were in place. But for some time now, I think most demand has been from the corporate sector.
Yeah, I mean, undoubtedly electric RVs are declining much faster compared with those for conventional vehicles. And as you say, corporate buyers are more active than individual consumers, particularly due to skewed government incentives across many regions, which then does, I guess, reveal a fundamental weakness in the second-hand BEV market. Essentially, the used market is just not there yet. BEV loans carry higher risks of RV exposure at contract termination, and as these electric cars depreciate faster, lenders may have to assign lower RVs on financing contracts to reflect the risk, leading to higher monthly payments for borrowers. Such cost increases could hinder the widespread adoption of electric vehicles, we think.
Thanks, Tom, and thanks everyone for listening. All the charts and data we mentioned are available in our European Auto ABS Quarterly Index and Credit Card Index. Reach out to us if you want to discuss further. Thank you very much.